So, I'm sure you heard this time and time again, right? Saving or investing, right? And typically, saving's never going to be enough, right? So, that's the question, to save or to invest. And you might think you'd find the answer in things that you have no control over: stock market volatility, inflation. And sure, those matter, right? The real answer to how best to grow your money, it depends on you, right? I've been saying this over and over again. Your situation is different from another person, right? So what you need is different. So, it depends on your financial situation, your time horizon, your tolerance for risk, your goals for the future, right? Maybe you choose to save and invest and for different reasons. But here, let's assume that you can afford to invest some money in stocks and bonds, that you're going to be able to endure the stock market dips without freaking out and pulling all your money out, and that your goal is to grow your money over several years, right? Like for retirement, right? That's where investments, typically outperform savings accounts just time and time again over the decades, right? So, that's what we're going to do. We're going to look at how investments have stacked up against these savings accounts in the past and how they're going to grow your money just quite a bit better. So, let's start off with talking about savings growth, right? So, saving, it's just one way to be sure you have the money you need on hand right now. So, most savings options, right? They're going to pay low interest rates. I mean, low, right? They involve basically no risk, and they make it easy to access your money without having to pay any fees or trade anything during like a stock market crash or a downturn or anything like that, right? Now, traditional savings accounts, high yield savings accounts, and money market accounts all have these three things in common. The other commonplace savings account, a certificate of deposit, a CD, right? It's a little different. It does require you to park your money and leave it for anywhere between like a month to 5 years or maybe longer, right? And often in return for a slightly higher interest rate. And slightly is the key word there. Like usually it's not much more, right? So if you're looking to grow your money, right, the drawback with all of these options has to do with inflation. Even at a low inflation rate of around 1%, inflation can undermine your return on savings and maybe even erode the money you put into your savings in the first place, right? Think about it like this: you're saving your money to buy a car. Inflation goes from 4% to 9%. That's a jump of 5%. Now, if that car jumped up in price 5% or even more, the down payment that you are saving for that vehicle is not enough, right? Inflation can really just, knock your legs out from under you, if you're not looking, right? So while a savings account can help you put money to the side for, you know, next year's wedding or a rainy day or a car, they don't often deliver much towards the goal of actually growing your money, right? What you put in there is basically what you're always going to have. Okay, well, let's look at investments for growth instead, all right? So, investing comes in a lot of varieties, right? Most of which can deliver higher returns on your investments if you can handle a little bit more risk and hold on to your investments for quite a little while. So let's look at the potential difference in growth between you putting $1,000 into a savings account versus you taking $1,000 and investing it. So, the savings option. Let's say the savings account on the small end, low interest rate is 0.25%. Let's say on the high end is 1% interest. Now, this is compounded daily and before taxes. All right? In 10 years, you're going to have on the small end, the 0.25% account, it's only going to be 1,025. The 1% interest rate is going to be 1,105 after 10 years. Ugh. Now, what if you had invested that money and not put it into a savings account? Moderate risk investment portfolio, stocks and bonds, right? Before taxes, just like the other example. After 10 years, you're going to have somewhere between about $1,900 to $2,800. Now you're saying to yourself, yeah, but that's only a couple $100 difference. Okay. But say you add an extra zero to the end of that. Instead of 1,000, it's 10,000. So instead of having $10,250, you're talking about having $19,000. All of a sudden, those numbers, they're big, right? Open your eyes a little bit. Now, some stuff like mutual fund investments, they're going to be popular because they offer a straightforward way to invest in portfolios of stocks, bonds, and maybe some other financial assets. Or even simpler, ETFs, exchange traded funds, which are also portfolios of financial assets, but they're traded like a stock, right? I mean, even another straightforward investment option might be an index fund that tracks a particular market. Now, even with these relatively simple investments, right, though the categories can seem limitless, I mean, big, medium, small company stocks, domestic, international stocks, bonds, tech sector, healthcare sector, corporate or municipal bonds. I mean, the list and options go on and on and on, right? So, you put your money in a savings account, you're just looking at the interest rate. When you're putting your money into an investment portfolio, a lot of options, right? So, let's look at the numbers then, right? Growing your money by investing. Just look at the numbers. So, with the kind of diversified portfolio that's often advised for investing, which is a 50-50 mix of stocks and bonds, it's delivered an average 8.7% annual return from 1926 to 2020. That's that's a good return. And it's taken, they use a big sample size. So you know that it's not a small sample size that's going to be skewed, right? Right? So, it had losses, right, in 20 of those 95 years, which is why investing in a long term compared with savings, right? Like, that's why everyone says investing is long term, right? Because you're looking for, you're going to have cycles, ups and downs, but if you ride the wave down and then ride it back up, 9 out of 10 times you're going to make a lot more money, right? A higher growth oriented mix of 80% stocks and 20% bonds, though, in the same time frame, delivered 9.8% on average, with losses in 24 years. All right? Almost a 10% average. That's pretty good. So, whatever your choice, you could certainly change over time along with your life goals, right? Many financial advisors say to start investing early so you gain the benefits of compounding interest, right? That's what happens when you reinvest your earnings from one year so the earnings themselves make money in the years that follow, producing a snowball effect. So the younger you are, the more time you have for compounding to work its magic. So hopefully this kind of shows you guys that, like, if you're saving money, like, that's fine for like an emergency fund, but if you really want your money to grow, you need to invest it. Now, I'm not saying you specifically need to invest in stocks or bonds or whatever. You could be investing in real estate, or you could be investing in a business, but the grow your money, you need to invest it. Save for your emergency fund and then invest your money in whatever way is more comfortable for you. Okay? I hope you guys got some good information out of this video. If you enjoyed it, man, hit that like button for me. If you're not subscribed to the channel, I'd appreciate it if you did. But till I see you guys in the next one, y'all be safe.